Okay, good afternoon, everybody. This is Shane Gaddy. I'm the managing partner for the Strong Gaddy Lee Wealth Management Group, and want to thank you for joining us for the Strategic Guidance for Life educational series. These meetings are intended to continually educate our individual clients as well as our retirement plan participants in hopes that it leads to better long-term financial decision making. Where possible, we try to provide these presentations that help explain questions we've been receiving or topics that are relevant. At the end of the year, the great thing is that we start taking a look at 2025, and that's what we're going to do today is take a look at the LPL market outlook for 2025. I'm pleased to introduce to everyone the newest member of our SGL team and our new Chief Investment Officer, Andrew Beatty. As our new Chief Investment Officer, he will provide economic outlook, market insights, and use his deep experience to help us develop our investment philosophy and strategy. He'll work closely with our firm's advisors, structuring tailored investment solutions that align to our clients' financial goals and risk tolerances. As our Chief Investment Officer, he will lead our investment committee and help us design portfolios. His team will be conducting in-depth research. They'll monitor market trends, assess risk factors, all of that to help develop investment recommendations in any type of market conditions. Before joining, Andrew was a senior investment analyst with Wells Fargo Investment Institute, where he was responsible for investment strategy and manager selection. In addition, he began his career as an institutional investment consultant with two of the leading global investment consulting firms, Cambridge Associates and Wilshire Associates. There he advised endowments, foundations, pension plans, and other institutions on making investment decisions, their asset allocations, which managers they hired, and their strategy selection. Andrew is currently and will continue to be a member of the LPL Research Strategic and Tactical Asset Allocation Committee, a member of the Investment Manager Selection Committee, and the Alternative Investment Review Committee. Andrew earned his BA in political science from the University of North Georgia rolls off the tongue here. University of North Carolina at Chapel Hill. And Andrew, it is a pleasure to introduce you to the SGL family of clients. Welcome.
Thanks, Shane. I really appreciate the intro. Didn't know we were going to get that deep into everything, but no, I'm very excited to be here. Very excited to work with you and the rest of the SGL team and your clients as well. I guess with that, should we jump right into the outlook?
So let's jump right in.
All right, perfect. So I will share my screen here so that everybody can follow along because I'm not a whole lot to look at. So we'll take a look at some charts and graphs as we get going here. We are calling this year, we're kind of slightly optimistic, I would say. And one of the things we want to do is take a look back at where we've been this year before we go into 2025. And U.S. equities, which you see here on the page, have advanced really since the most recent bottom, which was in late 2022. There have obviously been some pullbacks here. They have been relatively short-lived, and markets have really returned right back to their march forward. So it's been a very good market for equities. This is in the United States. In international markets, both in international developed markets and in emerging markets, the U.S. Comparatively, the U.S. has been by far the prettiest house on the block. To put some numbers on that, in the trailing 12-month period ending at the end of November of this year, the broad U.S. market has returned a bit more than 34%, while developed international and EM have only returned slightly north of 12. So we have far outpaced the rest of the world. In bonds, we have seen a pretty strong market for bonds in the last 12 months. The best performing sector has been corporate bonds or corporate paper. But that index is still only up about 8.7%. So it's really been an equity-led rally. That's where we've been. And we'd love to see that continue, but let's take a look at where we're headed. And the first thing we want to take a look at is the economy. Now, what we say here is the consumer may be slowing down, but there are some policy tailwinds and some other tailwinds that we may expect. The two tailwinds that we are really going to focus on here, both are related to spending. The first is business owners towards the end of this year have indicated that they were waiting until after the election to increase their capital spending or capex. And we think that 2025 is going to be ripe for an opportunity for them to deploy that cash. And so we do see a resurgence of capex spending for companies. Basically, every data point that we're following for that metric, including demand for power, demand for increased communication structures, et cetera, is on the rise. And that suggests that there is probably some upside as we go into 2025 for business spending. The second spending related tailwind is on this page, and that's consumer spending. Big thing here is that millennials are about to enter their peak earning season, peak earning and peak spending years. And there are a couple of dynamics at play there. The first is many of those households either bought or refinanced their homes during the 2021 period or thereabouts, where they were able to get very, very low interest rates. So home spending is relatively low by historical standards. Those folks also oftentimes changed jobs or got significant job salary increases during the period because the labor market was so tight. So disposable income for a lot of that group is pretty high. But there has been a bifurcation, and that's what you see on this slide, is that the top 20% or the top quintile of spenders are the ones that are really driving the consumer spending that we see in the US right now. The lowest quintile is obviously not doing so. They're the ones who've been directly impacted by the pandemic era rent increases and inflation. Everyone sees inflation, but it has a bigger impact on those lower earners than they do the higher earners. So when we are looking at consumer spending, and we think it's going to remain relatively robust based on those things we just discussed, where millennials and even people in older generations have more disposable income to spend, what we're really looking at is those top two quintiles, the fourth and the top 20% quintiles that are providing a lot of the consumer spending. Those are not going to be cohorts that are going to be impacted by typically rent increases because they own their own homes. They're not going to have a tremendous impact or have a tremendous detriment from inflation because they're just going to continue to spend and their wages have kept up or outpaced there. So that's the areas that we're looking for to track our consumer spending, which again, we think in 2025 is going to be pretty robust. Now, this slide is going to go back to what we all saw yesterday, which was the Fed. We are nearing an inflation target, and their inflation target is 2%. We are getting closer to that inflation target. The rate at which we approach that 2% is decelerating, however. We're not getting to their target as fast as the Fed would like, and that's why you saw yesterday, while they did cut interest rates, they also signaled, I would call it a hawkish cut. They signaled that they were going to effectively pause, and they decreased the number of cuts expected in 2025 to 2, which was really aligned with what we thought going into it. We did think there was going to be what we called a cut and pause from the Fed. So the actions yesterday and the rhetoric coming out of the Fed meeting were not unexpected to us. I think the market reaction was a little bit more severe than we expected. But what we think is that if we see this sort of volatility around Fed reports, around economic data, we can expect that as we go into 2025. So we are expecting a bit more volatility as we enter 2025, which presents us opportunities. I think Warren Buffett has the saying that you want to be greedy when others are fearful. And that's what we will be looking to do, is take advantage of opportunities where they exist. So let's get into the individual asset classes. We're just going to talk about stocks and bonds today, stay very high level. Happy to get into more detail if you would like, but we're taking a real measured approach to stocks in 2025. One of the things we want to look at is that when the Fed goes through a hiking cycle, which we have seen, and they first entered a rate cutting cycle, which we saw begin in September, based on the last 9 periods, the S&P 500 has posted a relatively modest return in those first 12 months following the first rate cut of about 5.5%. If, however, we remove the periods that had recessions, that increase or that rally in the S&P goes up to almost 11%. So there is a divergence there. What we think is kind of somewhere in between. We are cautiously optimistic on stocks going into 2025. We are seeing kind of mid-single digits to mid or to high single-digit returns for the S&P, driven largely by earnings, which we will talk about in just a second. That is very much more conservative than a lot of the other banks on Wall Street. A lot of people are looking at low double digits for the S&P return. We frankly are just taking a more conservative view there. I think if you told people you were taking a conservative view and maybe projecting an 8% return in the S&P in the early 2000s, they would have laughed at you because that wasn't considered conservative at the time. But I think we've all been a little bit conditioned to the last couple of years and seeing the rally that we've experienced. We just don't expect that to continue apace the way we've seen it. So the question is, are we going to see a steady increase or a relatively steady increase like we've seen the last few years? And the answer is probably not. We did see a drawdown a little bit yesterday after the Fed's announcement. What we think is that pullbacks, drawdowns, however you want to describe it, are incredibly normal. And we are probably and arguably overdue for one right now. We saw a bit of a pullback in June or July of this year. We've obviously saw a drawdown a little bit yesterday, but we haven't had that sustained 10, 12x% drawdown that is normal. As you look at the chart on the right here, if we go back about 21 years for the Russell 3000, and that covers really all U.S. stocks, large cap down to small cap, growth over to value. The average drawdown on an annual basis has been almost 15%. But despite those drawdowns, in 18 of the last 21 years, we have ended the year with a positive return for the Russell 3000. So something to keep in mind. And again, that's why we want to think about being greedy when others are fearful, because even when there is a drawdown, it's typically not going to be that sustained, and we can take opportunities to redeploy assets during those periods of volatility and make up ground or gain more ground as we come out of that. So I mentioned earnings earlier, and we've all seen this over the last couple of years. The Mag 7 has really led the way in terms of equity market performance, and that has largely been based on their impressive earnings. You see here on the right side, the orange line are the Mag 7 earnings. That's the Amazons, Netflix, Teslas, Microsofts, etc. Those earnings have been astronomical. Obviously, NVIDIA is playing a big part of that, but we do see those earnings, and this is the earnings growth, declining. So still growing, just at a slower rate as we go into 2025. Now, the other 493 companies that are in the S&P 500, that's the blue line. And what we see is those earnings and that earnings growth starting to catch up to the Mag 7. So that split between the two is starting to narrow. And that's why we are looking at this as an opportunity for a broadening out of performance. It won't be simply a concentrated bet where the Mag 7 runs, everything else kind of falls behind. We do think that there will be a broadening out. We'll see some value companies succeed. We'll see some small caps or mid caps obviously catch a bid. That's where we are looking. Again, we still prefer the US as opposed to international and developed markets. And we still prefer large cap compared to mid and small caps. That being said, we do want to take more of a broad approach and broader exposure to all of the asset classes so that we can catch those bids when they come into the market. So let's turn to bonds. And I know that bonds are relatively boring for some folks, but they do serve a purpose in the portfolio. We think this is really a golden age for income investors, and that's what we want to focus on. But the first thing we want to think about are the projected returns for bonds. And this is kind of a jumbled up chart here on the right, but what we're looking at here is the current yield of the broader Bloomberg US Aggregate Bond Index, which is the broad exposure to the U.S. bond market, it's nearly 5%. That, if we look at the historical data, that current yield is the best indicator for future returns. You see all those little tightly bunched orange crosses there. That means, based on the relationship, that there is a very high correlation between current yield and future performance. So those are the realized rather than expected returns from given points in history. If we have a current yield of nearly 5%, that implies an expectation of a 7-year total annualized return of 4.8%. Now, 4.8% annualized for bonds is incredibly strong, especially for an asset class that is meant to be your ballast, to be your balance, to be your safety net, with your equities posing and presenting most of the risk and potentially higher returns. Picking up almost 5% in returns in your bond portfolio, no one's really going to sneeze at that. That's a really good market for us. And then just to stop here for 1 second on the Treasury outlook. And I know that there is a new administration coming in. We're not really going to talk politics, but one of the things that we've been asked about recently is the U.S. debt. And while the main driver of interest rates we think will be economic growth, there is a secondary aspect to rates that we think is the amount of Treasury debt needed to fill the federal budget deficit. Those budget deficits are expected to stay high, potentially based on the incoming administration's policies, could go higher. What we have projected is the Treasury is going to have to issue trillions, and that's a T in trillions, more in Treasury debt to fill that expected deficit. But, and this is the complicating factor that you see on the right side of the page here, the Treasury will also need to roll over more than $6 trillion in Treasury securities that are set to mature in 2025. So the Treasury will need to find investors for nearly $8 trillion in the next year for U.S. debt. Now, that is an enormous number. Obviously, you can see based on the chart, that's more than we expect in the years to come. All of that being said, we do not see the U.S. government at being a risk of financial collapse. As long as treasuries are considered effectively risk-free securities, there will always be buyers, full stop. I want to make that very clear. But like I said, with the Republican sweep in November, what a lot of analysts have projected is that the deficit is likely to remain high or go even higher in the coming years. And with that amount of Treasury supply, interest rates may need to stay higher than otherwise expected, given that data. So overall, in bonds, we do like bonds, again, as a diversifier, as a ballast to the portfolio, as a safety to the portfolio. We do like investment grade, so higher quality bonds rather than lower quality bonds, because the yield that investors are receiving on those low quality bonds is very tight to the yield that they're getting in investment grade or high quality bonds. So we're not being compensated for taking on the additional risk in high yield or lower quality bonds. So we want to stay up in quality for the most part. So I will stop sharing now. Shane, I know that was pretty deep and somewhat in the weeds. We can definitely go deeper if you'd like, but wanted to send it back over to you. And again, thank everyone for having me on today and getting to meet you all, at least virtually.
Andrew, thank you for that. And just to set this up before we go into Q&A is like, okay, how do I take this? Or what do I do with this information? And for those of you who are individual clients of SGL, Andrew and his team take this information and it helps shape what the recommendations are for the adjustments that we make inside of the portfolios that we manage for our clients. For our 401k clients, who are managing their own portfolios, we can't make those changes for you. We can certainly help you plan and maybe discuss what most and best fits your plan, but take it like this. And again, use your own personal experience. When we're looking out there and we're using this data, what Andrew said earlier, he said, what do they like? If we're looking at U.S., they prefer, or what the data is showing, that large cap they favor large companies over mid and small. That doesn't mean we abandoned mid cap companies and small cap companies, but if you normally hold 10% in a certain area, maybe you would hold 8%, 7%, and you move that other 2 or 3% up the chain to large cap. Same thing on US versus international stocks. If you tend to hold 15% international, that's kind of your standard holding, what you usually hold. And we're saying US over international, maybe you lower your international exposure some. If you feel like international is going to do better, you don't believe the data, and because sometimes the data is wrong. You might go ahead and put more money into international. Same thing as bonds. What Andrew said, what do they like inside of bonds? They like corporate bonds right now. So if you're looking at what your alternatives are, treasuries, corporates, or other, you might lean more into corporate. So with that, that's how you use it. You take the data and use it. The other thing that I'll say is don't make any, as I mentioned a little bit, don't make any wholesale changes. This isn't about all in, all out. If you're investing in individual stocks, sometimes you're having to make those buy-sell decisions. But when you're investing in broad asset classes like you are, large cap, small cap, mid cap, growth versus value, it's a matter of the tilts that you're making along the way to try to take advantage of the economy and where it's at right then. But I never encourage people to be an all in or an all out. You have to be right twice, both when you get out and then when to get back in. So with that, going to open it up for any questions. Everybody currently is muted, but feel free to just click the button, unmute yourself if you've got a question. We'd love to hear from you. Okay, we understand sometimes this is a crowd and nobody wants to ask a question out loud, but we're not going anywhere. Our team, SGL, is here. You can call your advisor, you can call your retirement plan representative, and we're happy to assist and answer any questions. We certainly, can go a lot deeper into the LPL's 2025 outlook. We wanted to make this a broad overview. Our commitment to you is essentially that we want to make these under 30 minutes. But we always want to leave time for Q&A, so that's what we did today. But if you want to get a full copy of the 2025 Outlook, just email me at shane.gaddy@sglwm.com. You can find my information on your statement. You can find my information inside of your retirement plan package on that statement. Should have my contact information, or your advisor. Just email me and say, hey, I would like a copy of the full 2025 Outlook, and we'll get it straight back to you. But with that, Andrew, thank you for your time. For our clients and for our retirement plan participants, we want to thank you for your support of us. We want to thank you for trusting us with your well-earned and money. And we hope that everyone has a great holiday season. But we are working, so give us a call if you have anything. Thanks, everyone. See ya.